Whoa, wait a minute, look, up in the sky, it's a bird, it's a plane. No, it's me, the Einstein of Wall Street, from the balcony at the New York Stock Exchange, talking to you after a absolutely groundbreaking, breaking news, pivotal moment. Federal Reserve cutting interest rates 25 basis points, a long-awaited cut. Obviously, we know there's been a lot of pressure by the Prez on the Fed to do that. We finally got it. We can talk about what happened last year. We can talk about what's happening next year. We can give a little bit of a breakdown. And no one better to tell us the real, to get down and dirty into the nooks and crannies of the story is my man, Tim Anderson. Welcome to Trade Like Einstein and all the other great places this thing is going to be seen. So let's talk for a minute. We spoke right before the announcement, and we talked about what were the probabilities and the possibilities of what was going to happen. We looked back a year, right? Last year, I think there was probably more of a missed opportunity in July. The market, once again, was well anticipating an interest rate cut, which we did not get. We finally did get one in September, and that was after we had a market crash because of the Japanese stock market. The Bank of Japan raising their interest rate created that frenzy and that sell-off on the carry trade, and it created a crash on their market, 17.5%, as well as ours. On that Monday, we were down 264 handles. That next September, we did finally get a cut. And what happened then?
That
didn't happen now?
We got a double. We got
a shocker. Exactly.
In September, followed by 25 and 25.
Correct. And that's why I'm bringing it up, because when we talked, you said we're looking at a 25. I was hoping for a 50.
Right.
We know we would know that the Fed governor, who was very recently appointed by Mr. Trump, was the one dissenter who requested a 50 as well. So we were in the same dissent group, the three of us. Yeah. But we didn't get the 50. We know that last year when we got the 50, which was a bit of a shock, because we felt that July was a missed opportunity. We knew we needed a cut. Things were setting up for a cut. We got a shocker or ripped the Band-Aid off 50 basis point. And what did the market do? It sold off 1,000 points was the first initial reaction. It did rebound and go higher, obviously. But the initial reaction was a sell-off of 1,000 points. And we know why that was, because when you get surprised by that, the investment community goes, oh my God, he must know something that I don't know, and that we must be in worse condition than we are.
Well, markets were a little jittery at that point in time. Also,
Correct.
They're not really that jittery right now, although we have some dichotomies being building in the market between some of the major indices. We can get into that a little bit.
Okay.
But we got a 25. We're very likely going to get a 25 in late October.
Correct.
Last couple days of October.
Okay.
And then
we'll
see about December, but we'll probably get another one in December.
Okay, so we saw a 25, and your consensus is, look, we had a lot of different consensuses.
Yep.
One, somebody wanted to get, Gunlatch wanted 5 more cuts.
Yep.
Most of them said 2 to 3 more cuts.
Yep.
And basically, we just had a 25. If we get another 75, like 3 25s by year end, we'll have had
there's only 2 more
last
meetings.
Year.
There's only two more meetings. So if we're going to get 75, one of them's got to be
50.
50. I don't think we're going to do that. I think Powell is just hell-bent on being as deliberate as possible.
Okay.
The inflation data is certainly not going to all of a sudden go down so significantly on the next few readings. So we're probably going to get a 25 in October, although that is 4.5, 5. That's 5 weeks away.
Anything could happen. We know it's an economic data-driven decision. If we get a couple of
allegedly,
PPI, CPI, allegedly,
yeah.
CPI, whatever information. I just want to shout out to you, because I was on CNN the other night, and they were asking me and Dan Ives about the Fed meeting and the cut, and I quoted you, and I said, you know what, that elusive number of 2%. For the inflation target that Mr. Powell has been touting for over a year was really elusive in so many ways. And what he should have done was, when we got from 8.5 down to 2.5, we should have spiked the football and called it victory. Right. And I quoted you, right? And I said, that's my man Tim said that, and I agree with you. Yeah. It was almost like he was self-sabotaging himself, because like he almost wanted, I don't know if you said that, but it's almost like he wanted to get fired, because you know what? He could have painted a better picture. He held his ground. He did what he wanted to do. And the bottom line is, that number of 2 is one of the reasons it waited this long to get the cut to begin with.
He's got 300 PhD economists, all in support staff functions at the Federal Reserve.
Okay.
All of them are trained on Keynesian economics, and they're telling him 2%'s the magic number, and he's sticking to that.
But you realize from 8.5 to 2.5 was an amazing move.
You know what? Let's just not change the topic completely, but let's look at this from the other side of the equation.
Let's go. Pivot me.
What's going to have a bigger impact on how much of a cut we get in October is going to be the job market. Because the job market is and has been showing some signs of some weakness, or certainly
that was one of the bigger components.
And there were, and we got this annual revision where they took away 900,000 jobs.
That's big.
And what we see from the job market between now and the October Fed meeting could have a bigger impact than inflation, because even Powell at this
talked about it
event
a lot
that he's speaking at today, 30 to 45 minutes ago, said our policy is modestly restrictive. Okay. So if he wants to get to neutral rather than modestly restrictive, he's saying that to give himself room for another 25 basis point cut in October without getting the negative feedback from the critics that he's only cutting because Trump keeps badgering him.
Right. And you know what, though? He did say one which was curious. As opposed to his normal narrative of telling us how many he plans into the future, all he said after he did the cut was, this is not the last you're hearing from me in respect to cuts. He did not even give any more than that. He did also lay out the scenario that all the other governors were very distinct about 2 more cuts, 3 more cuts, and how they were going to pan out. To address what you just mentioned, if it wasn't inflation, it surely was the unemployment numbers, because we had more jobless claims than in the last 4 years, the biggest number ever. The revisions were 900 jobs, 1,000 jobs plus. We had come off of 2 weeks of 147,000 projected non-job payroll jobs created, and only came out with 47,000. So in a very multifaceted way, in such a big deal, jobs are a big thing. Now, you did illuminate me to a thing, and I've been talking about it a lot. You're just an amazing resource for my brain. Because you talked to me about how significant real estate, that one of the biggest things that will get impacted by cutting interest rates, obviously higher rates for longer is not good for anybody. However, we obviously have to work with the mechanism to do it, to cut them correctly. You just can't cut arbitrarily. But you illuminated me on the fact that real estate is such a multifaceted sector that impacts employment in a huge way. Because you described to me, even when we talk about building the data centers, and they're all it's all 5 years away, and I would say that more of the libs and the Dems are talking about, well, that's not going to do us any good. Why are you making a big deal over that? Is you made it clear as they have to be built. And they have to start being built now. And that is going to impact jobs. So don't tell me that it's 5 years away, it has no impact. It does have a big impact. Now, I'll let you talk in a minute. The real estate market getting jump-started by a cut in interest rates can impact employment in a huge way. Go ahead.
There's a big distinction to be made between real estate, housing. Let's say the housing part of real estate.
That was what I meant to say.
Because if you talk real estate, there's a lot of
I meant housing.
Office
You're
space and
right.
stuff like that.
Housing.
So let's talk housing. The housing market and the home building market and all of the derivative effects that feed off that have a huge impact on the economy. They don't have a huge impact on the job market in terms of looking at individual stocks. You know, there's 7 or 8 housing stocks. I'm not saying they don't matter. They're just not big
There's
market
not a direct
names.
correlation.
They're not big market names in the stock market in terms of their market capitalization, like the banks are, the tech is, energy is,
or even
like
Home Depot's Targets, those guys too.
You know, look, Home Depot has a much bigger impact in the market, much more widely known than any of the housing stocks. Although, look, the housing stocks are, can be good companies, can be good investments. They're just not big mega market movers.
Okay,
So aside from that, yes. When you're building, if home building was at a peak right now, inflation would probably be,
closer
inflation,
to
unemployment would probably be 3.7 to 4.
Wow, okay.
Maybe 4.
Because we're at 4.3 now, up from 4.1.
It's 4.3. Now look, 4.3 is still a very low number.
Yes.
If you go back decades and decades when
I was in
16%. when I was in school,
right,
they used to consider 4% unemployment
as full employment.
to be full employment.
Right. Imagine that.
And you, even if you got to 4.5 on the way down, you would consider that, oh my God, the employment picture is just unbelievably good. So now we're at 4.3.
Right.
Okay, so if we go to 4.4, go to 4.5, it might cause some headlines because that unemployment rate is always going to be a headline grabber.
Yeah.
But it's just, it can go up a little bit, and it might go up because more people are joining the labor force, because obviously when you figure out what the unemployment rate is, there's a numerator, there's a denominator, and if you get another million people to join
the workforce,
technically join the workforce, like say they're looking for a job, that will potentially make the unemployment rate a little higher, even without people getting laid off. Well, just because how many people are working
versus
how many people are.
Okay.
So like if someone you knew decided that, look, I've been looking for a job for 6 months, I haven't found one, I'm just not going to look anymore. They would declare they would be out of the workforce. But then if all of a sudden the employment picture got so strong and in areas where they're building all these tech centers, let's say, okay, or all these data centers, that people said, I haven't had a job for a while, but now there's all these job offers out, I'm going to go. He's joining the workforce. Joining the workforce. People maybe that retire and they move to South Carolina or Florida and they say, you know what, I'm kind of bored. I don't really play golf. I don't play tennis. I'm going to go work. I'm going to go work at the local hardware store or the local Home Depot 20 hours a week. They're joining the workforce. Okay, maybe that's
going to impact unemployment on the upside.
That's going to actually make, if they're joining the workforce and they haven't gotten the job yet, that's going to make make the unemployment rate.
Oh, I understand. They're in it, but they're on the sideline.
Right.
Okay, I understand.
Right. So that's not necessarily, that's this labor utilization rate that hovers in the low 60s. And that's going to make.
I totally get it.
That can actually be a positive sign for the economy, because the economy is so strong that people are sensing there's jobs out there. I'm going to go get one. And until they do, it just pumps up makes the pie bigger.
They're standing on the side of the highway, ready to work when they're ready. Now let's go into this for a minute. What's always more important is, even than the number, even than the press conference, is how does the market react? And we know the first reaction is a knee-jerk reaction. It's emotional, and then the next day is usually the follow-through of what the market happens to feel. 2 o'clock on Wednesday was the high. It sold off aggressively, but it didn't last there. It didn't stay there long, as every little pullback we've seen over the last number of months is, because in our opinion, we've talked about it before, there are so many people who are underinvested in the market and are waiting for that pullback, and they're not willing to give it 2-3%. They're going to, the minute anything goes on sale, their favorite leather jacket at Macy's goes down 10%. They don't wait for Christmas. They go and buy it. Same thing here. We had a pullback, 2:30, 2:45. We were back buying that market. We ended up closing the market flat, and on Thursday the market's rallied, and we've been rallying every day since. Even a couple of days that we opened down, we did midday reversals. Yes, yesterday we sold off in the morning, down 10 handles, and then the report came out about NVIDIA and the investment in OpenAI, and that just took the market off to the races. Right? And so, you know what? Are you comfortable with the market trading where it's trading at this frothy valuation, and this continuation for us to be flatlining or trending in a super bullish way coming into the end of third quarter?
Well, I would say yes, because look, we've gotten through most of September now. We haven't had this September swoon that we sometimes get. It can be a very challenging time on the calendar.
Seasonality and weakness in markets,
but we
potentially.
had a couple of pretty sharp corrections earlier in the year, and I think that took some of that away. So the market is very, it's a little rotational right now.
Yes, totally. And you illuminated me to that too, because I look at that every day now. I talk about this on my videos every day. When I look at the market, even though this week, every day, even though the market has been positive on both, and a lot of green on the screen in both the Dow and the S&P, the advances versus declines have been 50-50.
Yeah.
Now that is an example. Normally when you see a big buy or a big sell, you'll see it 4-1, 5-1, advances versus declines, or the other way around. You illuminated to me, watch that advance versus decline. That will tell you a lot more about what's happening in the market. Most people don't look at that. And when you have a market that's up, or a market that's down, and they're still 50-50, that's rotational.
Yes.
That's people that is not people dumping things, that's people getting out of one sector and into another. That's why we saw last week, the Russell hit a record high first time in 2.5 years. Small cap, mid cap, AI.
I think that was a little bit of a product of the interest rate cut.
Yes.
And not just the cut, but the fact that we're likely now to have two more cuts. And we're in a rate cutting cycle
Yes,
now. We're
yes.
You know, so the Russell stocks, the small cap stocks are very susceptible to interest rates because those that they borrow money off bank lines, they don't sell their own debt.
That was it, yes.
And that will
that will benefit them. That will benefit them in a positive way.
They get a big impact off the level of rates and off the potential of whether or not we might have our economic slowing, or maybe go into a recession. We're nowhere near a recession.
Right.
But that would hit the small cap sector much harder than the big cap sector. So the other thing is that there's a lot of portfolios that are balancing themselves out right now because we're like a week, a couple of days. We're probably 7 or 8 trading days from the end of the third quarter. So we're probably not going to get a market rout. That would be just people cutting off their nose to spite their face. But they can. You're going to have people taking some profits in stocks they've got big profits in. You're going to have people adding to positions a little bit.
Those who are playing catch up.
Because we're near an all-time high, there's going to be a lot of funds that want to show minimal cash on their book at the end of the quarter, that their investors don't say,
what are you doing in cash?
You're at 10% cash. I give you my money to invest
it. Yes, yes.
You know, we're going to have some rotational action. Now, there's this hot group of stocks they call the space stocks, you know, that are very hot the last 4 or 5 days. Rocket Labs is one of them. They took advantage of the big move in their stock, I think, and did a secondary late last week. So the stock gave up a little bit, but then you've got these other...
quantitative stocks are on fire again as well.
I was just going to mention the quantum computing stocks have been very hot, up a lot. The rocket stocks, the space stocks have been very hot, up a lot.
Tesla.
Some of the AI stocks have cooled off a little bit. Tesla, special situation.
Yes, of course.
You know, obviously. But that stock has been very strong. And
okay, then let me interrupt you and ask you a question. We are trading at record highs. We're coming into the end of the third quarter. It doesn't seem like anything, whether it's wars, interest rates, political unrest, earnings guidance, whatever it is, nothing seems to even give this market a breath, a pullback, a consolidation, a sell-off that we've seen ever since that wonderfully self-inflicted economic Armageddon that we had February, March, and April, right, which we dissent on as well. But all that being said, do you see anything on the horizon that potentially could make this market pull back? Pull back. I'm not calling anything negative. It's a pullback.
Right.
It's a healthy pullback.
So we're almost at the end of the third quarter.
Right.
So we get into the second week in October. We'll start to get third quarter earnings reports. And I think that what you would really need to get is some, not just an earnings miss, but a statement, a definitive statement from a couple of bellwether names in one sector or another that I'm certainly not predicting this or anything, but if the banks said, if one or two banks said we're starting to see a higher level of consumer charge-off on credit cards,
right,
or if somebody
consumer
said,
sentiment is
look,
getting a lot weaker,
we're starting to see some slowing here,
right,
or some slowing here,
right.
That if it was in a sector that has had a big run, and the financials have had a big run, and AI tech has had a big run, if
and also could be finally seeing, because we started to see the impact of tariffs on
that's
the
other
companies.
that's the other thing. Or if retailers said, you know what, we're
starting to see this eat away.
We're not going to inventory the way we have in the past because
Christmas,
we don't
shopping
know.
Season.
That's right.
Up.
And we're going into the holiday season, and that's when retailers usually, make
order big in advance when the market
large amount of their money.
Yes.
I mean, they called
at least 25%.
Right. They always called it Black. They always called the day after Christmas, the day after Thanksgiving, Black Friday, because that was literally the day on the calendar when retailers went from unprofitable for the year with 5 weeks to go to profitable, and then that built in all the way through Christmas.
And so look, so many of the components are going to be hell-bent on seeing how tariffs are going to impact that. Whether they buy big in anticipation, whether their orders, whether their orders and supply chain is going to be impacted a little bit about how the consumer sentiment is.
We've seen a couple of comments that, look, the low-end consumer is
struggling,
is spending a little bit less.
Right.
Well, look, what's the low-end consumer going to buy? The low-end consumer is going to buy toys and games
at Target,
made in China that used to sell for $3.99 that maybe are now selling for $5.99 or $7.99. And those sound like ridiculously low prices, but that's
reality.
That's reality. If you're in a family that has
living paycheck
3,
to
4,
paycheck,
5, 6 kids, and you're going to buy them toys or games for Christmas, and that price on an aggregate basis is going to be double what it was last year. That's going to impact your pocketbook significantly.
100%.
And unfortunately, there are a lot of people in the economy that are in that
school class,
that are in that level.
Group.
So
for sure.
That's something to watch out for. Watch the retailers, watch the dollar stores, watch what Walmart says.
Yes.
Watch
think about it. We are very blessed. We are very lucky, and we are humbled by the fact that we have good careers. We are comfortable. We think about it. The who is involved in the stock market. People are really the 1% of the 1%. There are people out there who are living paycheck to paycheck. And those are the people who are impacted by a school bag going up from $7.99 to $14.99 in the back-to-school sale because of tariffs. That was one of the fears back in February, March, April, when I was with Dan Ives talking about the interruption of supply chain, all the boats that were lined up in the China harbor that were wondering, do we fill up on all that stuff because this is back-to-school time? And we don't know if 145% tariff on a knapsack for a kid to go back to school just went from 4 to 9. Well, what's happening?
Look, the tariffs haven't gone that high.
No, they haven't. And that's something we know.
Certain retailers could have shifted into buying things from made in
elsewhere,
China to made elsewhere, and the price could be a little bit more.
And that may happen at Christmas as well.
So look, we might see. You got to watch what the retailers say.
Okay.
You got to watch what the banks say about credit card debt.
Yes, that's
and you
big.
got to watch what the tech companies say about is all the CapEx spending on AI still
is it on
there?
It's on schedule. Absolutely.
And it probably is. Now, obviously, we had this comment from this guy, Sam Altman, a few months ago that said, the AI thing is a bubble. Look, he's obviously a brilliant guy. He's a prodigy.
Right. Who's the OpenAI guy?
He's the OpenAI guy.
He is,
but he's also in his early 40s.
Okay.
So he has absolutely no historical frame of reference on the 87 bubble or even the internet bubble around 2000 because he was probably 12 or 13 years old.
Right.
So it's not, is it
We've
frothy?
seen the movie before.
It's yes, but it's price is way up. Is the whole AI thing kind of crazy?
Yeah.
Yes, it might be.
It is,
but it might
that's
be.
fine, but
it
it's a
might be in the
revolution.
second inning. It might be in the second
As
inning.
Dan says, we are in the
not-
second inning of a game going into extra innings.
It's not
It's
a bubble compared to what we saw with the internet stocks.
It's
in
way not
99 and 2000.
Correct. We are way not a bubble. We are in the second inning of a game going into extra innings. It is 8 p.m.
But it
and a
could be a
party that's
high-scoring
going
game.
to yes, and it's 8 o'clock and a party that's going till 4 a.m. and people are going to be out on the streets doing shots of tequila. You know what? You laid it out for me beautifully. Earnings and guidance will be important things to watch. The retailers and the banks will be important to watch on the impact of tariffs on people who are living paycheck to paycheck and a majority of the people in this country. And look, when markets trade at record highs for a sustained period of time, the only little bit of historic data that's true about every crash and pullback and consolidation and sell-off that we've had in our lifetime, 87, 2000, 07, 08, COVID, and the mini crash I called back in February, March, April, was before they happened, we were all at record highs.
Yep.
None of these happened when we were down. They happened literally February 12th of 2020 was the high of the market when we started to see the impact of COVID, right? February 19th was the high of the market when we saw this recent sell-off because due to the tariffs and Mr. Trump. So all that being said, we are at those record highs and markets continue to go up until they don't.
Right.
We all know that. And so while we've seen the movie a number of times, at this point, does it feel a little bit different because of all the things you've just mentioned? The AI revolution, right? The underinvestment by some of the bigger players who got caught off guard back February, March, April. The solid lifeblood of our market is earnings and guidance. We had 80% or more of the S&P beat, and guidance has been solid relative to last quarter when we had no guidance due to the tariffs. So all of the things that you and I would have talked about back in February, what would it take to check off the list and all the deals we're doing?
Yes.
Mr. Trump has done a spectacular job of checking the box when it comes to the EU, the UK, everybody except China, as far as making deals. He is a deal maker. And while we saw that, promised by Lutnick and Besant way back, deal, done, and that wasn't happening, while we were focused on other things, deals have been made. Deals are being done.
Sure.
Right? And so where we find ourselves here today is all the boxes have been checked off. The market feels strong, as you would call it. The market is you use a wonderful term.
Well,
it's constructive.
It's rotational right now.
It's rotational, but it's the way the market is trading.
The net's very positive.
Net is very positive, and money's being put to work. Money's being deployed.
So getting back to what we were talking about a little bit earlier in the conversation, we still have this issue with the Fed. Now, I saw a statistic right after the Fed meeting when they cut.
Okay.
And they said it's a little unusual for the Fed to be cutting when the economy is doing well and the market is at or near an all-time high.
Okay.
So someone mentioned 12 other incidences when the Fed had cut or started a cutting cycle when the market was at or within a small percentage.
So this has happened 12 times before.
12 times before.
Okay.
And all 12 times, 12 months later, the market is higher by an average of 16%.
Wow. That's a great number.
That is a great number.
That's an incredible statistic.
That is a great number. Now, also, just keep in mind that will help mortgage rates go down a little bit. That will help maybe unfreeze the
housing market and real estate.
The housing market. And then the other dynamic that's out there that you'll hear people talk about from time to time is that, and I don't know if Matteo, help me out here. Is it Gen Z or who has all the student loans out?
Oh,
who has all the student loans
out? Who has all the
Gen Z.
Right.
So there's a tremendous amount of student loans out there by people in there that went to college and
who are either now in their 25
years
or 30
ago, let's say 10
or their 30s
years
and
ago,
40s. Correct.
That those paybacks from paying back your student loan has been on hold by the government for since COVID. For 5 or 6 years. And now it's coming off hold. So you got to see what the spending patterns look like
for those people, Gen Zers.
For those Gen
But
Zers.
they are massive consuming
because that's going to
generation.
be all of a sudden. That's going to be like, all right, now I got to pay like $150 a month for my student
That's
loan.
going to come out of something else.
And that's going to be take away spending from something else.
Right, yeah.
So, it's not something that's talked about every day.
Yeah.
But I will say that it's out there,
Gotcha.
and just be on the lookout for some comment on spending from Gen Zers. And
Fascinating.
is the taking the student loan,
So
maybe
I
the
think-
travel and leisure stocks. They love
Exactly.
experiences.
Well, look, if I'm paying $1.50 on my loan, I may not be going out to dinner
They've got
as
no
much.
hesitation about going to a nice restaurant or spending $150 for a concert ticket,
Right.
or something like that. Somewhere along the line, that's going to get,
Impacted.
that's going to have more limited upside than it's had in the
Yes.
past, if not a little bit of a pullback.
Gotcha. I love that. So we're talking about, look, it's important in order, if you want to try and analyze what the market looks like going forward, consumer spending is key. And to look at consumer spending, a
Still
perfect
70%
example,
of the economy.
Exactly. And so one of the big keys is, that's what you're so wonderful at, is coming up with that idea that if we are able to understand consumer sentiment and consumer spending, we're going to be able to see what the writing is on the wall going forward. I think we've given you an amazing breakdown on why the market's trading where it is. I think we gave you a breakdown on what would it take to get the market to reverse and have any kind of a pullback. And I think, we've broken it down like nobody else does, right? This is simple lingo, simple language, which is what we try to do. Tim and I do it, Dan and I do it. We want you to understand what's happening in the market and feel comfortable investing in this market where it is, right? If today's high is tomorrow's low, it's not a big deal. And I know there's a lot of anxiety and fear around. Now, what I did see yesterday was fascinating and this is, we'll wrap it up with this, is the market was up and the VIX were up. Now, that normally does not happen. The VIX being the fear index is usually down when markets are up, okay?
Yeah.
Now, the way I interpreted it is that as the market gets to this frothy valuation with this irrational enthusiasm that nothing in the world is going to that's at old Wall Street, we used to walk around saying there's never another down day on Wall Street.
Right.
Eventually, there's going to be anxiety around that number. There's going to be anxiety about the fact that, markets keep going up until they don't. And that, it's a hard place to buy this market.
And there are some
that's legit.
hedge funds, institutions that will just, when the VIX gets cheap,
Right.
and it does at market tops, they'll just load up.
They'll load up on it. Right.
Load up.
That's their
on it
hedge.
because
That's a hedge.
they don't want to sell their stocks.
It's a beautiful.
And they say, if I lose $1 million on this VIX trade,
Right.
I don't care.
I'm making it up on the other
because
side.
I'll make.
So keeping that in mind, talking about a hedge, you've got market going up, crypto going up, and gold trading at record highs.
Well, crypto has had a hiccup
a little bit of
for
a
a couple
pullback,
days now
a little
because
bit of
of
a
a
hit.
liquidity
But that's
event
that's
overnight.
short term, right? That's interesting.
Yeah.
However, they're still buying them all at the same time,
Right.
So what we learned very clearly was that crypto is not a hedge against the market because it goes up when we go up, it goes down when we go down.
Right.
Gold, traditionally, as being that safe haven
Right.
asset,
Right.
is a hedge against the market because people buy that when the market's down. They want
Right.
something they can hold. But once again, gold is trading at record highs while the market's trading at record highs.
Right. So
is it that everyone's just buying everything they can get their hands on? Or is it
there's
just
a little-
return on investment that liquid?
I think there's a little bit of that, and I also think a lot of the conversation about gold is talking about how it's outperformed the S&P 500 this year, so it's way ahead of everything, and this is a little irrational.
Right.
But I think what those people are missing is that gold spent 20 years underperforming
Yes, it did.
the S&P 500,
okay. Yes,
and
yes.
now it's been breaking out for maybe a year, maybe 18
year and a half.
months.
Yeah, exactly.
And you know what? It's not going back
Yeah.
to 2,000,
No,
2,500.
it's not. It doesn't feel like that.
It's just
Yeah.
it
It's
was
in a new-
so overdue.
Yeah.
that
And
I don't
just like
view-
flatlining.
I don't view this move to be a bubblish at all for gold.
Yeah, and
it will pause and from time to time.
Yeah, no, and look, and it feels right.
Yeah.
At some point, it does feel good to be able to hold on to something, and
Yeah.
gold does seem to be an attractive thing.
Yep.
So you know what, ladies and gentlemen, I know I said look up in the sky, it's the birds are playing. It's Tim Anderson. He broke this down like nobody else can do. He gets into the nooks and crannies of what's going on and gives me, look, there are so many things in my narrative that I pull from some of the things that Tim says, and it's wonderful. So you know what? Look, I'm a team player. I'm a student of this market on a daily, minute-to-minute basis. We learn from each other. We learn from where we are, and we absorb all that stuff. It's been a pleasure chatting with you today.
It always is.
We are happy to talk to you once again really soon. That's all I got to say about that.